Now let us look at the next problem, that is problem number 4 in this particular case. Problem number 4 out there, let us look at problem number 4 out there. Coming to the fourth problem is not going to be very different from the third problem what we did. Again it is going to be only decision making. Again it is going to be only incremental decision making, exactly like what we saw in the earlier case. That is, at what stage? Again very simple problem. I have not taken any complicated problem at all. What we do is incremental analysis. We are doing incremental analysis. Incremental I do processing, I do further processing and sell it. Can I make more money? Can I make more profit? Incremental profit is what we are looking at in this particular case. Let us read the problem. Austin Wool Products purchases raw wool and processes it into yarn. The spindles of yarn can then be sold directly to stores and they can be used by Austin Wool Products to make afghans, basically afghans. Each afghan requires one spindle of yarn. Current cost and revenue data for the spindles of yarn and for the afghans are as follows. Data for one spindle of yarn. Selling price is $12, variable cost of production is 8, fixed cost of production based on 4,000 spindles of yarn produced is $2 out there. Data for afghan, selling price is $32, production cost per spindle of yarn, it is $10. That is, basically you go there, spindle, variable cost of production is 8, fixed cost of production is 2, so that is 2 is $10 out there, that is what you see. Variable cost of production for processing the afghan is $9. Fixed production cost for afghan is about $5 out there. Each month 4,000 spindles of yarn are produced that can either be sold outright or processed into afghans. If Austin Wool chooses to produce 4,000 afghans each month, the change in the monthly net profit income as compared to selling 4,000 spindles of yarn so is, that means they have to decide whether I should sell it as spindles or I should process further and sell it as afghans. Incremental analysis, that is all what we do out there. Incremental analysis is what I will do out there. Now let us take, for that matter, let us take this problem out here. What we do is incremental analysis. Incremental analysis is what we are doing out here. Let us look at number of units sold for afghans. It is about 4,000 units is what you are selling. Sale value, sale price and value. What is selling price per afghan? As you saw out there, price per unit out there is about $32 out there. That is 4,000 units out here. I will make it as 4,000 units out there. Sale price is about $32 out there. So that is basically this into my number of afghans. So I am going to make about 1,28,000 if I sell about, what do you call it, as about 4,000 afghans out there. I am sorry. Sale value. Let me look at the sale value of the spindles. Sale price and value of spindles. Out here, if I sell it as spindles, what is the spindle? If I go back to my problem out here, my selling price is $12 out there. So I am going to look at $12 out here, and then I am going to look at this into the same number of units out here, and this is what I am going to sort of take this in this entire thing. I am sorry. So in short, what is my incremental revenue if I sell as afghans? If I sell as afghans, what is going to be my incremental revenue? My incremental revenue totally is going to be, this is going to be my incremental revenue is about 80,000 rupees out there. This is going to be my incremental revenue if I sell it afghans. I got an incremental revenue of 80,000. What is my cost going to be? Let us look at my cost in that particular aspect. That is, what is the incremental cost out there? That is variable cost of production, incremental cost out here. Let me insert one more row out here and then write as incremental cost. Incremental cost in this particular case, let me write that as incremental cost out here. I am just saying variable cost of production to produce an Afghan is $9 out there, is to produce an Afghan is $9 out there. That is 9 into my 4,000 units. This is going to be my incremental cost of producing Afghan out there. My incremental fixed cost of production in this particular case is about $5 is what I see out here. So, it is going to be about $5 out here, and that is going to be, this is going to be the incremental fixed cost in this particular case out there. So, what is going to be my incremental profit? My incremental profit is going to be 80,000 is the incremental revenue. My incremental cost is 36 and then 20. My incremental profit is going to be 24,000 if I manufacture Afghans. So, decision is to go ahead and manufacture Afghans, as it results in an incremental profit of rupees 24,000 out there, or $24,000. Sir, you have not considered, the question that is going to come now is going to be, sir, you have not considered the cost of, what do you call it, as the cost of manufacturing the spindles at all out there. That is, you have not considered this particular cost out there, the variable cost and the fixed cost of spindles. I said, yes, I am not going to consider that. Because what is it I am looking at? I am looking at what is called as part of, go back to relevant costing. I am looking at making a decision. What is the decision? I have manufactured spindles. I can sell spindles, I can sell as Afghan, I can process for that. So, the decision point is, go ahead and sell spindles, go ahead and sell spindles, or go ahead and manufacture and sell Afghans. Relevant cost. What is the relevance? What is the cost that I am going to incur if I go ahead and manufacture Afghans? This is the cost that I am going to incur. What is the revenue that I am going to get? Incremental revenue I am going to get if I sell Afghan. This is the revenue I am going to get. That is all what I will basically look at comparing in this particular case. Am I with you on this? So, that is what that ends again on the decision making part of it. Now, we go to problem number 5 in this particular case. Okay, coming to problem number 5. Problem 5 is slightly more, I have just upped 1 or 2 notches out there. Again to do with decision making, again to do with contribution analysis. Let us sort of look at this problem. Glen Company makes 3 products in a single facility. These 3 products are the following unit product costs. There are 3 products A, B, C. Materials, yes. Labor, yes. Variable manufacturing overhead, yes. Fixed manufacturing overhead, yes. Unit product cost out. Additional data concerning these products are listed below. Mixing minutes per unit. There is some process which needs mixing out there, mixing minutes. Selling price per unit, variable cost per unit, monthly demand in units out. So, what is this variable manufacturing overhead? Variable selling cost is different from variable manufacturing overhead. So, these two are very different, and monthly demand in units. The mixing machine, see, now there is a constraint. The mixing minutes are potentially the constraint in the production facility. A total of 24,200 minutes are available per month on these machines. That means availability is 24,200 minutes only. Direct labor is a variable cost in this company, of course yes. Now required, how many minutes of mixing machine time would be required to satisfy the demand of all the 3 products? Number 2, how much of each product should be produced to maximize the net operating income? Number 3, up to how much should the company be willing to pay for 1 additional hour of mixing machine time if the company has made the best use of the existing machine capacity? Let us come to the third question little later. Let us solve the first and the second as of now. That is what is more important. Let us solve the first and the second as of now. How many minutes? Now let us go back to the problem out there. I am just going to divide the screen now into 2 parts. If, that makes it little more easier. Now there are, what is the problem? There are basically 3, that is I would say, I would talk about, I would say phi A. Let us sort of look at phi A out there. There are 3 products A, B and C. A, B and C, there are 3 basic products out there. Let us sort of center it as we go along. In a minute from now, I am just centering it out there. I have just centered it out. Let us look at what is the cost, what is the demand. They will say monthly demand. First question, what is the number of mixing minutes required? Monthly demand out there. Monthly demand out there is 2000 units out there. In this case, it is about 4000 units, and in this case, it is about 2000 units out there. Monthly demand in units. So, this is the monthly demand what I basically have of these 3 products out there. This is the monthly demand I have of these 3 products out there, and let us stick to this monthly demand out there in this particular case out here. I am just going to center this. Not working. I don't know why. Anyway, that is okay. No idea. Anyway, let's leave it there. Okay, let's leave it there. Let's not tinker it too much about it. Now let us look at what is the mixing minute per unit requirement. Mixing minute per unit out there. What is the mixing minute requirement per unit out there? Let us see this. It is about 3.7. It is about 3.4. And it is about 3.9 out there. So, I will have to increase the, what do you call it as in this particular case, the decimals out there, yes. So, total mixing minutes for the demand, for the demand out there, total mixing minutes that is there required for meeting the demand in this particular case out there, total mixing minutes that is required for meeting the demand in this particular case. Let us sort of look at, in this case I am just wrapping the text, and that is nothing but this into this out here, that is all. And I would say the total mixing minutes required out here as of now is a total of this plus this plus this out here, that is 28,800 mixing minutes is required for meeting the required demand of all the products. Now let us look at phi B. Now let us look at phi B. What is it? There is a constraint to available mixing minutes. What is the available mixing minutes out there? The available mixing minutes is only 24,200. So, you have a shortfall of about, what do you call it as, the shortfall is about 4,600. Now, what is the objective function? Maximize my revenue for every mixing minute that I have utilized. So, to maximize it, what do I need? I need what is the contribution per unit. Let us go to the contribution analysis. Let us go back to the contribution analysis. Let us start working on the contribution analysis. Let us say selling price of these products out there. Let us say selling price of these products is 59.20, 60.10. That is what is given out there. I have just taken it all these only from the data that is here in this particular case, as you can see. I am going to pick up use all this data out there. And then it is going to be 55.30 out there. This is the selling price of all these products out as we go along out here in this particular case. 60.10. Yeah, I am sorry. Thank you. Next, let us look at what is the cost, direct material, then direct labor, then variable manufacturing overhead. Then what happens? Variable selling overhead. Then we have total variable cost, because that is all the variable cost what I have. Let me check again. Direct material, yes. Direct labor, yes. Variable manufacturing, yes. Variable selling, yes. Fixed cost, let us not worry about it as of now. Let us look at all these costs. Variable manufacturing is 12.8, material is 12.80, 9.30 and then 4.70 out there, and my labor is 14.1 and 14.9 and then what is called as $10 out there. My variable manufacturing is 1.2, 0.9 and then 0.5 out here, and variable selling overhead is $2.9, $2.7 and $3.7 out there. So, what is my total variable cost out here? My total variable cost is, I just have to sum this up, and this is my total variable cost out on all the three cases. So, now that I have the total variable cost, let me calculate my contribution. What is my contribution? My contribution is selling price I have minus my variable cost is my contribution out there. This is the contribution I have, and this is all the contribution what I have. This is all the contribution what I have. Ideal circumstances, I would say this is number 1, because this gives me the highest contribution. This is number 2, this gives me the second highest contribution, and the ideal cases this is number 3, because this gives me the third possible contribution out there. Yes, that is what I would have ranked. Ideal case without constraint. Without a constraint. But there is a constraint. What is the constraint? Mixing minutes. Now, what is it? What is the objective function? Objective change and changes. Maximize my contribution for every unit of that mixing minute. For every unit of that mixing minute. Maximize my contribution for every. For example, here I spend 3.7 mixing minutes and I make a contribution of 28.20, whereas I spend about 3.4 mixing minutes out here and I make a contribution of 3.2, 32.2 and so on and so on. So, what is the contribution? Ideally is contribution per mixing minute, that is the constraint. So, contribution per mixing minute is, this is the number of contribution I have, and for this contribution I earn by using 3.7 mixing minutes. So, per minute I am getting a contribution of 7.62. Whereas in this particular case I earn 32.230 and my number of mixing minutes I use is about 3.4. So, I make about 9.5 mixing minute, 9.50. In the case of what you call it as last one, I use about 36.40, I have a contribution and I make a mixing minutes of about 3.9 and 9.33. So, now what happens? My ranking changes. My ranking based on key factor changes. Now, my ranking becomes, this becomes 1, this becomes basically 2 and this becomes 3 out there, because this ranking is dependent on what do we call it as, in this particular case, the key factor. In this particular case out there, the key factor is this. Now, I will decide my production plan. Now, I will decide my product mix. Now, I will decide what is called as my product mix out there. Now, I will decide what is my product mix in this particular case. I will say my product mix. I will say what is my product mix out there. Now I will go to decide my product mix. I will say to manufacture, what is the total available? 24,200 is the total mixing minutes available. Let me say I will manufacture product B to the capacity, because that is maximize rank number 1, that is utilization to that is what happens is the product mix I will manufacture 4,000 units of this product, and that means mixing minutes consumed out there will be 13,600 minutes mixing minutes. So, what is the available mixing minutes after this? The total mixing minutes is 24,200. The available mixing minutes after this is still the 10,600. Now, mixing, I will also go for maximum of this 2,000 units of this, and the mixing minutes that I will be consuming for this is about 7,800. So, what is the mixing minutes available for this after consuming this, that is after this also is going to be, that is all 2,800 mixing minutes is going to be available. What am I going to do? I am going to use this 2,800 mixing minutes for manufacturing product 3, that is product A in this particular case. That is how many units am I going to manufacture? I am going to say this is the number of mixing minutes that is available, and each unit requires 3.7 mixing minutes. So, I am going to manufacture 756, or I will say I will remove the decimal here. I will say I am going to manufacture 757 units of product A out there. This is going to be my product mix in this particular case. This is going to be my product mix. You can say that, sir, what is this? What is the maximum profit contribution? The contribution is going to be total contribution total contribution is going to be this into what is called as the contribution per unit. This is what I have basically got, and I am basically going to be looking at this particular contribution in all these cases, and the total contribution is going to be sum of all these 3 put together. This is going to be the total contribution. What are the fixed costs? Allocated fixed costs. Please note, sir, you can say, please note, it is allocated fixed cost. It is not fixed cost, which is basically per unit. It is always allocated based on the number of units you manufacture. Allocated fixed cost out there, overhead. So, allocated fixed cost is 18.5 into 2000. For this number of production units, this is the fixed cost per unit. So, what is the allocated fixed cost? My fixed cost is going to be 18.5 into what is called as the number of units, ideal number of units that I would have manufactured out here. This is what it is. And this fixed cost will continue even if you do not manufacture product A, because it will have to be borne by some other product out there. So, the fixed cost is fixed irrespective of whether you manufacture or not. Whereas for B, let us look at, it is about 17.2. So, 17.2 into what we call it as number of units out there, and for C it is going to be 23.7 into 7 into what we call it as the number of units is 2000, and this is going to be the total fixed cost out here in this particular case, and this is going to be the total fixed cost in this particular case, and this is going to be the total fixed cost. So, ultimate profit or loss is going to be, that is 70,641 is going to be the profit or loss out there, and this profit or loss will be the maximum. You try any other product mix. This product mix is the best ideal product mix given the constraint. For this constraint, you try with any other product mix, it will always be less than this, the profit will be less than this. This is the maximizing the profit. Now, let me go back to the question and then talk about 5C. There is something called as 5C out there. Let me sort of talk about 5C in this particular case out here. Let us look at the question out there. The question says, what is 5C? Up to how much would the company be willing to pay for one additional hour of mixing machine time if the company has made the best use of the existing mixing machine capacity. So, what is the number of units you need to manufacture still? If I look at what is the shortfall out there, shortfall between the ideal number of units and what you call it as the product mix what you have got, the shortfall is about 1243 units out there, shortfall in units. What are the mixing minutes required for the shortfall? For the shortfall out there, that is, this is the number of, and the number of mixing minutes per unit is going to be this. You can say that 4600 mixing minutes is required out there. What is the cost per mixing minute out here in this case? They have given some cost per mixing minute. Unfortunately, mixing minutes per unit is given. There is no cost specifically per se per mixing minute that is basically given out there. So, what happens? Not necessary. This is the number of mixing minutes that is required, mixing minutes required. So, what is your ideal profit? Profit is 70,641. In case you want to break even by giving over time, in case you want to break even by what do you call it as, what is that, what is the word they use out there? By to pay, by paying additional cost out there for mixing minute. Then what happens in this particular case out here? What is the maximum that you can pay? 70,461 is the profit I make at the stage. And this is the number of mixing minutes I require. I can pay up to about 15.36 in this case out there. That is all what I can pay. I can increase the cost by about 15.336 out there if I make 15.36. Additionally, I can basically break even. Anyway, that part you can basically ignore it. Thank you. Now, let us look at the next one out here, the sixth question, and I have two more questions out there. With that, we will close for them. So, next I think I have two more pieces of problems out there. This is basically, with that I will end the decision making part of it. After that, we move to the next part, that is the budgeting part of it and so on. Sinclair Company's single product has a selling price of $25 per unit. Last year, the company reported a profit of 20,000 and the variable expenses were totaling about 1,80,000. The product has a contribution as a 40% contribution margin ratio, please note. Because of competition, Sinclair Company is forced to will be forced in the current year to reduce the selling price by $2 per unit. How many units they have to manufacture in the current year to earn the same profit as in the last year? Let us get some things, facts very clear out here. That is, we are looking at the sixth problem out there. Now, again decision making. Now, first of all, we have to understand something called as, in this particular case, what did he say? He talked about what is the contribution margin out here. They talked about what is contribution margin. What did he say? 40% is the contribution margin. What does it mean? My selling price minus variable cost, that is what we call it as contribution, is 40% of my sale value out there. That is all. So, in short, 40% of my selling price minus my variable cost will be equal to the fixed cost plus profit what I have made in this case. So, what happens is 40% of my sale, I do not know the sale value, variable cost I know 1,80,000 will be equal to my fixed cost plus profit of 20,000, 2 lakhs, 2 lakhs is the profit if I am not wrong, yeah 2 lakhs out. This total is equal to about 40% of the sale value in this particular case. That means this fixed cost, that means if this is going to be what do you call it as 40% in this particular case, then what is your variable cost out here? One second. If fixed cost plus profit is equal to 40% of the sale value, then my variable cost will be equal to 60% of the sale value. So, if fixed cost plus profit is equal to 40% of the sale value, then my variable cost is 60%. So, variable cost in this case is 1,80,000 out there. So, if variable cost is 1,80,000, that is 60%, then 40% is how much? 40% in this case will be, you can just do the calculation, it is 1,20,000 out there. 60% is 1,80,000. That means 60% is the cost, 40% is the contribution margin, 60% is the cost. That means cost 60% is 1,80,000. That means what is 40% out there? 40% of it. If 60% of it is 1,80,000, calculate that. 40%. What is the 40% of it? 1,20,000. You can basically calculate that. So, how do we get this? Very simple, sir. Very simple. For example, by 60% is my cost. Cost is 60%. I'll make it percentages, no problem. My fixed cost plus profit is 40% because my contribution margin is 40%, that is equal to my contribution margin out there. My variable cost, which is 1,80,000. So, what is my fixed cost plus profit? My fixed cost plus profit will be this 1,80,000 if I have to use the parenthesis into 40% divided by, what do you call it as 60% out there is 1,20,000. So, profit is known, profit is given out there, profit is known in this particular case. As you can see in the text, he says profit is 20,000. So, profit is known. Now, my profit is 20,000. I'm going to reduce the decimals out there now this. So, what is my fixed cost? My fixed cost is 1 lakh. Obviously, the difference between the two, I will say difference between these two out there, my fixed cost is 1 lakh. I know my fixed cost, I know my variable cost, I know my profit. So, what is my sale value? My sale value, what is my sale value? My fixed cost plus my profit plus my variable cost out there is my sale value. My sale value is also known 3 lakhs. Selling price per unit is given out there 25. Number of units I manufacture, I sell, I would say, is nothing but the sale value, divided by selling price per unit. I have 12,000 units, I sell, number of units I sell 12,000 units. Now, what do they say? So, what happens? If this is the number of units, what is the selling price per unit? We know what is the variable cost per unit out there, per unit. Variable cost per unit is 1,80,000 is the total variable cost divided by 12,000 units, that is variable cost per unit is 25. So, current contribution is $25 is the selling price, $15 is the variable cost, $10 is the current contribution out there. Proposal. What is the proposal out there? What is the proposal? New selling price will be less by $2. So, what happens? New selling price will be $25 minus this $2, that is going to be the new selling price. My variable cost per unit is going to remain the same. My variable cost per unit is going to remain the same. So, what is my new contribution? new contribution $8. Desired profit is the same 2 lakhs which was earlier given somewhere 20,000 which was given somewhere out here, the earlier 20,000 out there. This is not decimal, this is not in percentages. 1 second. It's 20,000 out there. My fixed cost is known. My fixed cost is known. So, what is number of units to be sold to earn the desired profit? Number of units to be sold to earn the desired profit out there. What is my fixed cost? My fixed cost is 1 lakh. What is my desired profit? 20,000 is my desired profit. What is the contribution per unit? New contribution $8. So, the number of units I need to sell is I need to sell 15,000 units to earn the same profit at a price reduction of about $2 out there. We solve one more question on decision making, and with that we will close the class. We will close the session out there. We will close the session out there. That is, I am looking at the 7th problem in this case.